week. So Bank of England yesterday, 25 basis point hike. Vote split was the same as the last meeting, 6-3. Haskell, Saunders and Mann pushing for 50 basis point hikes, their fifth consecutive hike. The Doves probably tactically voted for a 25 basis point hike instead of holding out to reduce those chances of a 50 basis point move. Inflation's forecast to rise slightly above 11% in October as that off-gem energy price caps lifted. That's now more than 5 times the Bank of England's inflation target. GDP's forecast to shrink by 0.3% in Q2 as opposed to the gain of 0.1% expected previously. The hawkishness in the meeting was from the guidance that's been updated. They'll act forcibly towards inflationary pressure, and no dissents on that either. Bank rate is priced for 3% at the end of this year. That's 175 basis points. There's 4 meetings left, so that configures to 350 basis point hikes and 125 basis point hike. The one issue for the Bank of England as to why they need to be moving more aggressively and keeping in line with other banks is that commodities are priced in dollars. You can't drill an oil well in the City of London, but if your currency continues to weaken against the dollar, it's your import inflationary pressure. We're in a different regime now. You know, you want a stronger currency in this environment, inflationary backdrop. ECB anti-fragmentation tool, the ECB want it ready by July, and they're going to do a little operation twist where they will sell core bonds and buy peripheral bonds in the hope that as core bonds yields rise and peripheral bonds yields drop, that'll compress the BTP Bund spread. We're already actually seeing a bit of that taking place now. Visco, ECB governing council member, gave us a bit of a range of where he wants it to trade between 150 basis points and 200 basis points. And then lastly, to finish off with the Bank of Japan, out earlier this morning, they remain resolute in their dovish stance, and they didn't change policy. They didn't alter their yield curve control target, despite the fact that bond futures are pricing in a break of that peg. There was one notable change to the statement, that they want to pay careful attention to moves in the yen and the FX market, but I still see the USDJPY weakening, as we've seen this morning, up by over 2 big figs as the outlet valve to release that pressure that by the Bank of Japan not easing back on the yield curve control.